My name is Afiq Zakwan bin Rizal. My student ID number is 2025236162.
Name is Muhammad Arif bin Maisham. My student matrix number is 2025221002.
My name is Putri Shadina bin Faizan, and my number matrix is 2025230106.
Assalamualaikum. My name is Muhammad Naufal Hakim bin Mu'alyas, and my matric number is 2025229052.
So, imagine investing your hard-earned savings in a company because its financial statements show strong profits and steady growth. Everything appears promising, so you decide to invest. However, a year later, the company suddenly collapsed, and you discover that those profits were never real. Unfortunately, situations like this are not just fictional stories. They have happened to many well-known companies around the world, causing billions of dollars in losses and destroying the trust of investors. This highlights the importance of today's topic, accounting fraud, challenges, impacts, and future directions in financial reporting. Throughout this presentation, we will focus what accounting fraud is, why it remains a major challenge despite existing accounting standards, the impact it has on businesses and society, the challenges faced by accountants, and finally, the recommendations that can help strengthen financial reporting in the future.
Before discussing accounting fraud in details, I'd like everyone to look at the iceberg on the screen. An iceberg is an excellent illustration of accounting fraud because only a small portion is visible above the surface, while the majority remains hidden underwater. Research by Dyke, Morse, and Zingels in 2024 estimates that only 1/3 of corporate fraud cases are ever detected, meaning that almost 2/3 remain undiscovered. This tells us that the fraud cases we hear about in the newspaper or on social media represent only a small fraction of the actual problem. Hidden fraud may continue for years before it is discovered. During that period, investors continue making decisions based on misleading financial statements, bank approves loans using inaccurate financial information, and employees may unknowingly work for companies that are already experiencing serious financial problems. As a result, accounting fraud is not simply an accounting issue. It is also a business issue, an economic issue, and more importantly, an issue of public trust. This is why accountants, auditors, regulators, and company management all have an important responsibility in ensuring that financial reporting remains transparent, reliable, and ethical. Before we examine its impact, we first need to understand what accounting fraud actually is.
This slide compares accounting errors with accounting fraud. Although both may result in an inaccurate financial statement, they are fundamentally different. Let us begin with the first comparison, which is intent and mechanics. An accounting error occurs unintentionally. It may happen because of human mistakes, incorrect calculations, or accidental omissions during the preparation of financial statements. On the other hand, accounting fraud is intentional. It involves deliberately manipulating or falsifying financial information in order to mislead users of financial statement for personal or organizational gain. The second difference is the primary driver. Accounting errors are generally caused by process failures, lack of technical knowledge, or inadequate oversight. In contrast, accounting fraud is usually driven by pressure to achieve financial targets, weak corporate governance, and an unethical organizational culture. Finally, there is an important difference in how each issue is addressed under the Malaysian financial reporting standards. Accounting errors can normally be corrected through retrospective restatement under MFRS 108. However, accounting fraud cannot simply be corrected by changing the numbers. Once fraud is discovered, Companies may face regulatory investigations, legal action, financial penalties, and severe reputational damage. More importantly, investor confidence may already have been lost. This comparison also helps explain why accounting fraud remains an emerging challenge for the accounting profession. Traditional accounting standards such as the MFRS provide guidance on how financial statements should be prepared, but they rely on management reporting honestly and ethically. When individuals deliberately manipulate financial information, accounting standards alone cannot completely prevent fraud. Therefore, the challenge is not that accounting standards are weak, but that the fraud involves intentional deception, which goes beyond what accounting rules are designed to control.
Now that we understand what accounting fraud is and why it remains a challenge, let us examine its impact on business, investors, and the economy. At first glance, accounting fraud may seem like a problem that only affects one company. However, its consequences extend far beyond that organization. As shown on this slide, the first impact is misstated financial statements. Financial statements are one of the most important sources of information used by investors, banks, creditors, regulators, and even employees when making decisions. When these statements are intentionally manipulated, they no longer reflect their company's actual financial performance. As a result, stakeholders make decisions based on false information. This leads to second consequence, which is reduced stakeholder confidence. Investors lose trust because they realize the information they relied upon was inaccurate. Banks become more cautious when approving loans, suppliers may tighten credit terms, and shareholders often lose confidence in management. Over time, this creates the third and most serious consequences, the erosion of capital markets. Capital markets depend on transparency, credibility, and investors' confidence. When major fraud cases become public, confidence in the market declines, making investors less willing to invest and increasing uncertainty across the financial system. Therefore, accounting fraud is not simply an accounting issue. It threatens the stability and efficiency of the entire financial market.
To better understand the scale of this problem, let us look at some evidence. According to research by Dyke, Morse, and Zingeles, corporate fraud is estimated to destroy approximately 830 billion US dollars in shareholder equity every year. This figure is astonishing because it represents more than just financial losses. It reflects the loss of investor confidence, declining company valuations, legal costs, regulatory penalties, and long-term reputational damage. When fraud is exposed, companies often experience a sharp decline in their share prices within a very short period. Investors may lose a significant portion of their investment, employees may face retrenchment, and businesses may struggle to obtain financing due to reduced credibility. Furthermore, governments and regulators are often forced to spend additional resources, investigating fraud, and strengthening regulatory oversight. Therefore, the true cost of accounting fraud extends well beyond the organization itself. It affects shareholders, employees, creditors, customers, and even the broader economy.
Unfortunately, accounting fraud is not limited to one country or one industry. As shown on this slide, several major corporate scandals have demonstrated how serious the consequences of accounting fraud can be. One well example is Enron in the United States. Enron manipulated its financial statement by hiding billions of dollars in debt through complex accounting techniques. When the fraud was exposed, the company collapsed. Thousands of employees lost their jobs and investors lost billions of dollars. Another example is WorldCom, where management falsely reported billions of dollars in profits by recording operating expense as capital expenditure. This became one of the largest accounting scandals in history. In Japan, Toshiba overstated its profits for several years because of intense pressure to achieve financial targets. The scandal severely damaged the company's reputation and resulted in major governance reforms. Similarly, Satyam Computer Services in India falsified its financial statements by inflating its assets and profits, causing a significant loss of investors' confidence and raising concern about corporate governance. Although these companies operated in different countries and industries, they all share one common characteristics: the intentional manipulation of financial information. These cases demonstrate that accounting fraud is a global issue rather than an isolated incident. They also remind us that strong accounting standards alone are not enough. Ethical leadership, effective governance, and robust internal controls are equally important in protecting the integrity of financial reporting.
We have just seen how accounting fraud can cause significant damage to businesses, investors, and even the global economy. However, an important question remains: why does accounting fraud continue to happen despite strict accounting standards and regulations? So the answer lies in understanding the people behind the fraud. As shown on these slides, one of the most widely accepted models for explaining fraudulent behavior is the fraud triangle, developed by criminologist Donald Cressy. The model explains that accounting fraud is most likely to occur when three conditions exist at the same time. So the first element is pressure. This refers to the motivation that pushes an individual to commit fraud. Examples include pressure to achieve profit targets, satisfy shareholders, maintain a company's share price, or secure performance bonuses. In difficult financial situations, management may feel tempted to manipulate financial statements to make the company appear more successful than it actually is. The second element is opportunity. Fraud becomes possible when there are weaknesses in internal controls, ineffective monitoring, or poor corporate governance. If employees believe that fraudulent activities are unlikely to be detected, the opportunity to commit fraud increases significantly. The final element is rationalization. This occurs when individuals justify their unethical actions. They may convince themselves that they are only borrowing money temporarily, protecting the company, or simply doing what everyone else does. When these three elements, pressure, opportunity, and rationalization, exist together, the likelihood of accounting fraud increases substantially. This demonstrates that accounting fraud is not only an accounting issue, but also a behavioral and ethical issue. Understanding these underlying causes is essential because preventing fraud requires more than simply following accounting rules.
Understanding the causes of fraud brings us to another important challenges. If accounting standards already exist, why do accounting fraud cases continue to occur? The answer is that accounting standards provide a framework for preparing financial statements, but they cannot prevent individuals from deliberately acting dishonestly. Let us begin with MFRS 101, Presentation of Financial Statements. This standard requires companies to present financial statements fairly, faithfully, and consistently so that users receive reliable information for decision making. However, MFRS 101 assumes that management reports transactions honestly. If management intentionally records fictitious sales, hides liabilities, or manipulates financial information, the standard itself has no ability to detect or stop those actions. Next is MFRS 108, Accounting Policies, Changes in Accounting Estimates and Errors. These standards provide guidance on correcting accounting errors through retrospective restatement. While this approach is effective for genuine mistakes, it is much less effective in cases of accounting fraud. Fraud involves intentional deception rather than accidental error. Even if fraudulent financial statements are corrected later, investors may already have suffered financial losses, companies may face legal action, and public confidence may have been permanently damaged. Finally, MFRS 15, Revenue from Contracts with Customers, establishes clear rules for recognizing revenue based on the transfer of goods or services and the satisfaction of performance obligations. Despite these requirements, some companies intentionally recognize revenue too early, record fictitious sales, or manipulate revenue figures to present stronger financial performance. This demonstrates that even comprehensive accounting standards cannot completely eliminate fraud when management deliberately chooses not to comply with them. Therefore, the main weakness is not the accounting standards themselves. Rather than the limitation is that accounting standards are designed to regulate financial reporting, not human behavior. They rely on integrity, ethical leadership, effective internal controls, and strong corporate governance. Without these elements, accounting standards alone cannot completely prevent accounting fraud. This is why organizations must combine compliance with accounting standards together with ethical leadership, effective governance, continuous monitoring, and modern fraud detection technologies.
After understanding the causes, impacts, and challenges of accounting fraud, the next question is, how can we reduce the risk of accounting fraud in the future? Although fraud can never be eliminated completely, organizations can significantly reduce its occurrence by creating a stronger culture of integrity and accountability. As shown on this table, our first recommendation is to strengthen internal controls. Effective internal controls ensure that financial transactions are properly authorized, reviewed, and monitored. Practices such as segregation of duties, regular internal audits, approval procedures, and continuous monitoring help reduce opportunities for fraud. Our second recommendation is to promote an ethical organizational culture. Ethical behavior should begin with senior management because employees often follow the example set by their leaders. Companies should establish clear codes of ethics, provide regular ethics training, and encourage transparency and accountability throughout the organization. The third recommendation is to strengthen corporate governance. Independent boards of directors and audit committees should actively oversee financial reporting and challenge management when necessary. In addition, organizations should implement confidential whistleblowing channels so employees can report suspicious activities without fear of retaliation. Together, these measures create a stronger control environment and significantly reduce the likelihood of accounting fraud.
While good governance remains essential, modern technology is also transforming the way organizations detect fraud. Today, traditional auditing is increasingly supported by artificial intelligence, data analytics, and continuous monitoring systems. Unlike manual reviews, these technologies can analyze millions of transactions in a very short period and identify unusual patterns that may indicate fraudulent activities. For example, AI detects duplicate payments, unusual revenue trends, unexpected journal entries, or transactions that fall outside normal business patterns. Data analytics also enables auditors to monitor financial information continuously instead of only performing periodic reviews. As fraud techniques continue to become more sophisticated, accountants must also embrace technological innovation. Therefore, the future of fraud detection will depend on combining professional judgment with advanced technology to improve transparency, accuracy, and efficiency.
However, technology alone cannot eliminate fraud. One of the biggest changes required is a shift in the mindset of accountants themselves. Traditionally, accountants have focused on preparing financial statements and ensuring compliance with accounting standards. Today, their role has expanded significantly. Modern accountants are expected to think critically, question unusual transactions, identify potential risks, and apply professional skepticism throughout the reporting process. In other words, accountants are no longer simply record keepers. They are trusted professionals who help protect the integrity of financial reporting. To succeed in this changing environment, future accountants must develop not only strong technical accounting knowledge, but also ethical judgment, communication skills, digital literacy, and the ability to work alongside emerging technologies such as artificial intelligence.
In conclusion, Accounting fraud remains one of the greatest threats to the credibility of financial reporting. Throughout today's presentation, we have learned that accounting fraud extends far beyond financial losses. It weakens investor confidence, damages corporate reputations, and reduces trust in capital markets. We also discussed that although accounting standards such as MFRS provide an essential framework for financial reporting, they cannot completely prevent intentional fraud on their own. This is why strong corporate governance, effective internal controls, ethical leadership, and modern fraud detection technologies are all equally important. As future accountants, our responsibility extends beyond preparing financial statements. We are responsible for protecting the integrity, transparency, and credibility of financial information. This means continuously improving our technical knowledge, embracing new technologies, maintaining professional skepticism, and upholding the highest ethical standards throughout our careers. Ultimately, financial statements are more than just numbers. They represent trust. Once that trust is lost, rebuilding it is one of the greatest challenges any organization can face.